how do you value an idea? I mean, really think about that. How do you put a price on something that could totally change an industry, but right now has zero, zip, nada in revenue? Well, that's maybe the single biggest puzzle in venture capital. And today, we're going to break down exactly how the pros try to solve it.
This is the million-dollar question, right? Or maybe the billion-dollar question. For a founder, you're trying to sell a dream. For an investor, you're trying to find that one true signal in a whole lot of noise. When all the normal business rules about profit and sales just don't apply, what are investors actually looking for?
You know, judging a brand new startup by its revenue is kind of like judging a tiny sapling by how much fruit it's producing. It's not there yet. A big, mature company is like a full-grown tree. You can measure it by its output, right? Its annual recurring revenue, or ARR. But a startup? Oh, that little sapling is all about its potential to one day become that tree. All right, so here's our game plan. We'll kick things off with this core dilemma. Then, we're going to talk about the real goal every startup is chasing. After that, we'll dig into the clues you can find in the data and the signals you get from the people involved. And finally, we'll tie it all together and look at how the entire growth playbook is being totally rewritten. Okay, first up, let's really frame this problem. Why are the old school ways of measuring a business just so wrong for a new one? And here's the key. Metrics like revenue are what we call lagging indicators. Think of them like a rearview mirror. They tell you where you've been, not where you're going. They confirm that a company has already figured it all out, the product, the sales, the customers. An early-stage startup, they haven't had the time to figure any of that out yet. So you have to completely flip the script. Instead of measuring what's already happened, smart investors are on the hunt for leading indicators. These are the little clues, the breadcrumbs, that predict future success. The question shifts from, what's your revenue, to what evidence do you have that you're going to build a massive revenue engine down the road? So if revenue isn't the goal, then what is? Well, the North Star for every single early-stage company can be boiled down to three little words: product-market fit. Product-market fit, or PMF for short, is the absolute holy grail. It's that magic moment when what you've built is exactly what a specific group of people desperately needs. It's the destination, right? Not the starting line. And the entire journey to get there, well, that's what investors are betting on. And this is what makes it so real. PMF isn't just some number on a spreadsheet. It is a feeling. All of a sudden, sales get easier. Customers start telling their friends. You can barely keep up with all the demand. It feels like the market is literally pulling the product right out of your hands. That's the feeling everyone is chasing. Okay, so how do you measure your progress towards that feeling? Let's get into the hard numbers. These are the quantitative clues that investors are scouring the data for, way before PMF is fully baked. Long before people are willing to pay for something, they have to be using it a lot. Investors are looking for obsessive engagement. Are people showing up daily or just once a month? That's your daily to monthly active user ratio. Are they actually using the main features that solve the real problem? And are they sticking around week after week? That last one, cohort retention, is so crucial. It proves your product is becoming a habit. Here's a classic, but it's a classic for a reason. You ask your most active users one dead simple question. How would you feel if you could no longer use this product? If more than 40% of them answer very disappointed, you've got a massive leading indicator. It means you've built a must-have, not just a nice-to-have. Now, let's talk about a key financial metric for a minute, the burn multiple. This is all about efficiency. The formula is pretty straightforward. You take the money you spent this quarter, your net burn, and divide it by the new revenue you added. It answers one simple question. How much does it cost you to make a new dollar of revenue? Now, this number might be high at the beginning, but investors have to see that it's getting better over time. But look, data only tells you half the story. At these super early stages, the qualitative stuff, the human factors, are often way more important. So let's look at the signals you get from the people. So if it's not just the numbers on a spreadsheet, what is it? When a company is basically just an idea and a couple of founders in a garage, what are investors really betting on? It's the team. Plain and simple. Full stop. The product is going to change. The market's going to shift. Your strategy is going to get thrown out and rewritten a dozen times. The one thing that stays constant is the founding team and their ability to figure things out. You are betting on the jockey, not just the horse. And these are the traits that really matter. Is the founder personally obsessed with this problem? We call that founder market fit.
How fast can they learn and adapt when things go wrong? Because trust me, things will go wrong. Do they have the grit to just keep going when it gets brutal? And maybe most importantly, do they have a deep, genuine empathy for their customers? Because that's where all the best ideas come from.
So, we have the hard data, and we have the soft signals from the people. The true art of early-stage investing is taking those two very different things and weaving them together into one single, believable story about the future.
And this brings us to what might be the most important concept of all. It's not about where the company is today, it's about its trajectory. It's about the rate of improvement. A team that is learning and getting better super fast is way more exciting than a team that's just stagnating, even if their numbers look a little better right now. Investors are betting on the slope of the curve, not just a single point on the graph.
It really boils down to a pretty simple three-step mental model. First, you find the spike, the one thing the company is just world-class at. Maybe it's incredible user love, maybe the founder's a genius. Second, you have to validate that spike by actually talking to customers. Do they see it too? And third, if everything lines up, you make a bet on that team and their trajectory.
Okay, and finally, let's talk about how this whole landscape is changing, because the definition of traction and the path to growth are evolving right underneath our feet.
The old playbook was pretty simple, right? You charge your company based on how many employees use your software, and you lock them into a yearly contract. But the new playbook, it's all about usage. Growth isn't tied to headcount anymore, it's tied to value. How many API calls did they make? How much data was processed? How many tasks did an AI agent complete? This totally changes what early traction looks like.
And of course, AI is just pouring gasoline on this whole fire. Tiny teams can now build unbelievably powerful products faster than ever. And what that does is it compresses the whole timeline from idea to revenue, which means the growth clock is ticking faster for everybody, and investor expectations are rising along with it.
Which really leaves us with this final thought to chew on. If early-stage investing is all about a bet on the future, a bet on potential, then maybe all those other metrics we talked about, the engagement, the surveys, the burn multiple, maybe they're all just proxies for one single thing, the team's ability to learn. So is that it? Is a team's learning velocity the only metric that truly matters in the end?